Today, we're tackling a question that's been on many people's minds. Why is the Japanese yen so weak? As of today, May 14, 2025, the yen is trading at around 146.73 to the US dollar, which is significantly weaker compared to historical levels. But what does this mean? And why is it happening? Let's find out. As you can see from this chart, the yen has been on a steady decline against the dollar, with some fluctuations along the way. This weakness has raised concerns among economists, policymakers, and everyday Japanese citizens. So, let's unpack this issue step by step. First, let's understand what currency strength and weakness mean. When we say a currency is weak, it means that it takes more of that currency to buy one unit of another currency. In this case, it takes more yen to buy one US dollar. A weak currency can make imports more expensive, which might lead to higher inflation, but it can also make exports cheaper, potentially boosting trade. However, for a country like Japan, which is heavily reliant on imports especially for energy and food, a weak yen can be a double-edged sword. Japan imports a significant portion of its energy needs, including oil, natural gas, and coal. It also relies on imports for many food items. A weaker yen means these imports become more expensive, putting upward pressure on prices and reducing purchasing power for Japanese consumers. Looking at the current situation, the yen has been on a downward trend for several years, hitting multi-decade lows. For instance, in April 2024, it reached 160.17 per dollar, its lowest since 1990, as reported by The Guardian. Although it has strengthened slightly since then, it's still considered weak by historical standards. This weakness has prompted concerns and actions from Japanese authorities, including interventions to support the yen. Let's look at some key milestones in the yen's recent history. In March 2024, the Bank of Japan, BOJ, ended its negative interest rate policy and raised rates for the first time in 17 years. Despite this, the yen continued to weaken, reaching 160 per dollar in April 2024, prompting the government to intervene in the forex market, as noted by Reuters. So, why is the yen weak? There are several key factors at play here. First and foremost is the interest rate differential between Japan and the United States. The BOJ has maintained very low interest rates for a long time, recently hiking rates to a range of 0% to 0.1%. In contrast, the US Federal Reserve has kept its benchmark rate much higher, around 5.25% to 5.5%, as per Bloomberg. This wide gap makes the US dollar more attractive to investors seeking higher returns, leading to capital outflows from Japan and putting downward pressure on the yen. This chart illustrates the stark difference in interest rates. Investors can earn much higher returns on US assets compared to Japanese ones, incentivizing them to sell yen and buy dollars. Another factor is Japan's monetary policy. The BOJ has implemented quantitative easing and yield curve control to keep long-term interest rates low, contributing to the yen's weakness, as discussed by Goldman Sachs. Additionally, Japan's high debt levels, public debt exceeding 200% of GDP, limit the government's ability to stimulate the economy through fiscal policy without causing further currency depreciation. Japan's debt-to-GDP ratio is one of the highest in the world, constraining its fiscal options. Any attempt to increase spending or cut taxes could lead to further debt accumulation, potentially worsening the yen's position, as highlighted by Brookings. The weak yen has both positive and negative impacts on Japan's economy. On the positive side, it makes Japanese exports more competitive, boosting industries like automobiles and electronics. For example, companies like Toyota and Sony might see increased demand for their products abroad because they are cheaper in foreign currencies. Here's a look at Japan's export performance. Despite the weak yen, exports have been relatively stable, but there's potential for growth if the currency remains weak. However, on the negative side, it increases the cost of imports, particularly energy and food, fueling inflation and squeezing household budgets. For example, Japan is heavily dependent on imported oil, and a weaker yen means higher fuel costs, which can trickle down to higher prices for consumers, as noted by Al Jazeera. Inflation in Japan has been creeping up, partly due to higher import costs. This is a concern for the BOJ, which has been trying to achieve its 2% inflation target, but now faces the risk of overshooting it. In response to the yen's weakness, Japanese authorities have taken steps to support the currency. Notably, in late April 2024, the Japanese government intervened in the foreign exchange market, spending approximately 19.8 trillion, 60.7 billion to buy yen and prop up its value. This intervention helped stabilize the currency temporarily, but its long-term effectiveness depends on underlying economic fundamentals, as reported by Nikko AM Insights. Here's what happened during that intervention. The government's action was aimed at preventing further depreciation and signaling its commitment to currency stability. Looking ahead, the outlook for the yen remains uncertain. If the interest rate differential between Japan and the US persists, the yen may continue to face downward pressure. However, if the BOJ continues to normalize monetary policy by raising interest rates further, or if the US Fed starts cutting rates, this could help strengthen the yen. Additionally, any signs of economic recovery in Japan or improvements in productivity could also support the currency. Analysts have various predictions for the yen's future. Some expect it to remain weak, while others see potential for strengthening if certain conditions are met, as discussed in Marketplace. In conclusion, the weakness of the Japanese yen is primarily driven by the significant interest rate differential with the US, Japan's monetary policy, and its high debt levels. While a weak yen has both advantages and disadvantages, it poses challenges for Japan's economy, particularly in terms of import costs and inflation. The Japanese government and central bank will likely continue to monitor the situation closely and may take further actions to stabilize the currency if necessary. As always, the forex market is influenced by a complex interplay of economic policies, global events, and investor sentiment, making it a fascinating area to watch.